Last week, the US released a series of key inflation readings. Both the CPI and PPI increased 3.8% and 6.0% YOY in April, respectively, significantly exceeding market expectations and reaching multi-year highs. The numbers indicate that underlying inflationary pressures are once again accelerating. The latest inflation figures suggest that escalating geopolitical tensions in the Middle East, especially those pertaining to Iran, are increasingly feeding into the broader US pricing structure through higher energy costs and ongoing supply chain disruptions. More importantly, the pass-through effect is no longer confined to the energy sector. Price increases have become increasingly broad-based across multiple commodity categories, indicating that the current inflation cycle is expanding in scope rather than remaining concentrated in a narrow set of inputs. Broader commodity indicators reinforce this view. The S&P GSCI Total Return Index is now up more than 60% YOY. Historically, commodity prices have exhibited a strong positive correlation with US inflation, and at times have also served as a useful leading indicator. If the current trajectory in commodity prices is sustained, US inflation is likely to face further upside pressure, with a move towards 6% or higher no longer inconceivable. Relative to the current 3.8% YOY CPI reading, broader inflation risks may therefore still be underappreciated by the market. Taken together, the continued strength in broad commodity prices suggests that US inflation is unlikely to have peaked this year. From a historical perspective, the current inflation dynamic bears certain similarities to the prolonged inflationary episodes seen between 1966 and 1982. If historical patterns continue to hold, the US could face persistent and meaningful upside inflation risks through 2028.
Thanks for watching. That's all for today's update. Don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis. See you next time.